Hi, it's Navy Dowdy here in the Chicago area in the Midwest in the great United States. An often overlooked tax planning opportunity comes from not fully understanding how you can use your cars as a deduction on your tax return. It's very common for people who have a Schedule C sole proprietor type business to claim their mileage on automobiles, but the privilege of using personal deductions on a tax return is not limited to someone who's filing a Schedule C. For instance, a landlord might own 3 apartment buildings and file a Schedule E on his personal return and not feel like he is self-employed since he has a full-time W-2 job. However, the use of his personal car on that Schedule E is just as deductible as if it was from a Schedule C sole proprietor, and honestly, who can generate any passive income without having some expenses? If you have an online eBay business, for instance, you drive to the post office to mail your packages. If you're a landlord, you drive to the hardware store to get nuts and bolts, and of course, you drive to the properties when necessary. There's almost always an automobile component to everything in our lives. The topic of whether to actually claim mileage versus actual expenses is often overlooked as well. Many people who put in mileage are simply given that option by a tax preparer initially when they start generating income that included business use of a vehicle. The preparer didn't think about the choice of actual expenses versus mileage. What else do you need to know? The IRS, when you first put a car in service on a 1040 tax return, gives you the option of using actual expenses or mileage. So what is the mileage deduction? It's basically actual expenses easy. Like many parts of the tax code, the IRS gives you the simple form method option of tracking automobile expenses. You could instead keep track of the tires, mufflers, and other repairs, keep track of the cost of insurance, the tags, the upkeep, etc., and deduct those expenses at a certain ratio. But many people at tax time have not kept the receipts for those various expenses, and because it is bookkeeping intensive, so the IRS eventually came up with a methodology called miles, where they're given people a predetermined formula. This year, that expense amounts to 56 cents a mile for business deductions, which represents what the average person would spend on gas, tires, oil repairs, maintenance, if they drive their car a certain number of miles. In other words, $5,600 is estimated to be what you would have spent on oil, muffler, tires, etc. after driving 10,000 miles. Is it always smart to use mileage? Not necessarily. Often people with small businesses don't really have to go many miles, but they have older cars that require more repairs and maintenance than a brand new car. For instance, a landlord lives 6 miles from 2 apartment buildings and 9 miles from the hardware store. His average week would be 35 miles round trip to the properties. At 56 cents a mile, it's a very small deduction against his taxes. Let's assume he owns a 9-year-old vehicle that's starting to wear out. When he puts that vehicle into service on his 1040 form, instead of using miles, he could claim actual expenses. He spends money on mufflers, tires, on a transmission repair for that vehicle, for example, totaling $3,000, a portion of which is deductible for the landlord business. In this case, he would have 3 times the tax deduction by using actual expenses over miles. However, if the same landlord leases a brand new vehicle that's under warranty, which covers oil changes, maintenance, and all the other expenses for the next 3 years, then he should claim miles, because under the actual expenses model, he would have $0 expended. A deduction of 56 cents per mile for 30 or 40 miles is better than zero. When you first put a car into service, trade cars, buy a new car, start a new business, you actually have to stop and think about how you're going to use that vehicle, how the deductions work, and whether you use actual expenses or mileage. Once you've made the determination, however, if your circumstances change, you can't change the formula with the IRS. They require that you continue to use actual mileage or actual expenses for the entire time that the vehicle is used in service for the business. What if your situation changes? Let's assume that the same landlord living a few miles away from an apartment building with a brand new car just started a common carrier business and is going to drive hundreds and hundreds of miles a week. How do you fix that problem? You could trade cars with your spouse. Take the car out of service from your landlord business and put it in service under the new business. And then you can charge and change from actual expenses to mileage or vice versa. The point is that this takes some strategizing. Going to a tax planning firm and not just a tax preparation firm can help you catch little things like the mileage versus actual expenses choice, which can make a difference of hundreds, even thousands of dollars of money back on your taxes, instead of somebody just automatically using mileage because it's all they know. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.